Hey, how you doing? Welcome to Wall Street Weatherman. I'm Greg, and this is the first show of the pulse and the vibe of the market right now. And I call it that because, like I've said before, I'm not here to make a forecast of what's going to happen. I I look at possibilities. I assign probabilities to what might happen. I keep a lookout for them, but I am here today in this market that I have in front of me. That's all I can do. And um, I there's just people love to forecast, and it doesn't ring true to me. We can look at what we have, we can look at what may or may not happen and has happened and talk about that. And so, with that in mind, this show, it's not going to be, I thought about it, it's not going to be on any certain cadence. Okay. It's not going to happen every, you know, week on the nose or every couple of days. It's going to happen when I feel like there's a significant moment in time, whether it's a shift in the market, a specific event, or a big macroeconomic worldwide occurrence, or uh, a, a shift, between stock sectors. And whenever it's there, it's there. And we're just going to listen and with ears wide open, and that's when I'm going to check in with you on this. And so I wanted to do the pulse and the vibe today because I feel there's a possible shift that's underway. Okay. And by possible, I mean that it could revert to what it was a month or 2 months ago, but it also might be a change, a moment in time when it's significant and a time to pay attention and to reevaluate what you're holding, and if you're holding stocks. And so, just to review, 2025, um, we had the big tariff scare at the beginning of April, and stocks went down sharply and came back up sharply and have continued to rise, generally speaking, since then. But in all of that, there were times when everything was rallying. Okay. um, all sorts of the 11 different sectors, and we'll go through all that. It's going to be awesome. The different sectors of stocks when everything was doing well, and then there was a focus on technology. And let's face it, technology has been such a market leader over the last 5 years, 10 years. We can go back in time, but especially this year, it always seemed to me like the touchstone. Okay. Like the market in general was going up, but it would go out and maybe the financials would do really well. And then when people started to take some profits in them, or they started to reach, higher valuations, every time the market would come back to technology and to the artificial intelligence play at the center of technology. Um, more recently, um, more recently, there's been the speculative trade about pre-revenue companies, which is to say companies that haven't made money yet, and you can look at them as high speculation um, and higher risk for sure. And also Bitcoin and cryptocurrency and altcoins. Um, Within the last about 2 months, there were some trades going there, but now those have pulled back and shown a little bit of weakness. And again, once again, we're back to technology, and we're back to artificial intelligence at the center of it. And at the center of that artificial intelligence, I would put two companies: OpenAI, which is not a public company yet, and NVIDIA, which is a public company now. But throughout this, heading into November 2025, which is where we are now, the market has become more and more focused, more and more. the breadth of the market has become narrower, okay, which means, to simple way of saying that those AI, I'm going to use AI for artificial intelligence, those AI stocks have continued to do well and um, and rise, but the number of stocks doing well has decreased. So it's a smaller and smaller number at the top and a larger and larger number going down and hitting, new lows. Um, but the market itself has continued up. So what that means basically is that that's a little bit concerning for me because the market is resting on fewer and fewer stocks and fewer themes. So it doesn't have a broad base. It's got a narrow base of technology, of AI, and of specifically OpenAI and NVIDIA. And just within, so that's the setup going into where we are now. And just within the last 2 weeks, maybe 3 weeks, I go back to when Oracle, which does databases and has moved into the artificial intelligence, sort of business and data center business. Um, they they started off a moment of change to me over the last 3 weeks. And in a nutshell, the market is wondering now. Before this, it was everything AI was great. If you were, water AI or desk AI, your stock went up if you just mentioned it. But now the market seems to be asking itself, well, wait a minute, these huge companies, the largest of the tech companies, of course, Microsoft and Meta and Google, and have been spending, as we know, billions and billions of dollars for this AI build out. But more recently, that spending moved from cash into debt. Okay. And that is concerning the market because throughout history, when debt and problems with debt become, or when debt becomes a problem, that's when really, concerning times and drastic changes can occur. And so those of the largest of the large companies have, turned more from just paying cash from their amazing earnings into financing with debt. This build out of AI, and Oracle has leveraged itself. In other words, it's leveraged more to the debt side of financing than any of the other players. And as a matter of fact, for next year, 2026, the forecast is that Oracle is going to be cash flow negative, uh, moving from positive to negative. In other words, they're going to spend more than they make. And we all run a household budget. We all, you know, that is what it is. And so that's become of concern. And in that debt financing conversation, the market is now asking, well, wait a minute. You guys are building like there is no tomorrow, and now you are borrowing to do it. Where is the return on investment? It's been a couple of years for the AI play now, okay? We want to see where the return is coming from. We want to see where this is all going, okay? Where it's going to pay off. So return on investment, which you'll hear people say as ROI. And uh, so it started with Oracle a few weeks back for me, and then last week when the biggest companies were reporting earnings, there was a divergence between Meta, which was Facebook, and Amazon and Google. Okay, Amazon and Google showed that they are growing their use of AI, whether it's Amazon Web Services and increasing the use of their cloud business to Google and its users on Gemini, its AI search bots, etc. platform. But Meta has just been buying and investing in the AI engineers paying hundreds of millions of dollars, the paychecks for these people. It's crazy. So taking all of the top AI talent from all these different companies and obviously buying compute and semiconductors, but they haven't shown where it's being used yet because Meta is most of their revenue comes from advertising. So since last week and reporting earnings, Amazon and Google had a nice tick up showing the use and the return on investment, and Meta took a pretty sharp dive because they only talked about how they were increasing spending and they have not demonstrated where that return is coming from yet. So it doesn't matter what's true or not. This is what the market's seeing, and this is what the market is trading on. You can say Meta's going to be incredible, and they're going to come out with a whole ecosystem that's going to blow people's minds. Okay, that's great. But the stock is still down 20%, whatever it is at this point in time. Anyhow, that gets me to think about, the market in general. And again, would you rather be right or would you rather make money? Because if you invested in Meta a couple of weeks ago, you would be down pretty sharply right now. So that's the difference. The market is rewarding those companies that are showing that return, and punishing the ones that are not. And which brings me to the next example, which is CoreWeave. CoreWeave is a company that came public earlier this year. So it's a new public company. And they are basically building out data centers and leasing out the compute. And they are doing it on a huge scale as well, with massive investments. And just this week, they reported their earnings, but they had a hiccup because one of their infrastructure providers, called Core Scientific, which was a company that had the data center capacity already built and in place because they were primarily initially a crypto mining company, mining cryptocurrency, Bitcoin, and so they already had everything in place. So they had promises to, on delivering, that compute and that physical equipment to CoreWeave, but it fell behind. And there's a lot of merger stuff that they were going to buy them, and so maybe there's some bad blood. But that was another part of this. When the mind of the market sort of shifts, it can, instead of looking for all the positive, it can try to pick out the negatives, which is what I feel is happening in the last 2.5, 3 weeks, and is continuing. So with CoreWeave, they were punished again pretty sharply on that report. The market questioning, well, wait a minute. All of this build out and all of this spending is one thing, and we already have a question about the return on that equity, but is this even realistic? Are we even going to be able to build all of this in time? And then they start asking questions about, well, wait a minute, everyone's talking about energy being the pinch point of, you can build however many gigawatts worth of data centers you want, but if we don't have the energy infrastructure and the energy generation in this country right now, which we don't, by the way, and this is absolutely a negative catalyst watch that I have in my mind, is where is that going? Well, now that CoreWeave had a problem with the deliverability of this compute, now the market is saying, well, wait a minute, what's next? The energy? Because if we can't get the data back and forth, then these data centers are just going to sit fallow in the middle of, the desert or wherever. And so that's just sort of the vibe. That's the feel that the market has been so positive, but now I really see a distinct change in that, saying, well, wait a minute, We're done with just giving you a blank check. We want to see where you're spending it. We want to see a return on that spend. We want to know if you have a resilient supply chain and diversified suppliers. We want to know specifically what your energy plans are. And so it's more questions now than it was a couple of months ago, earlier this year. And a few anecdotal comments. Anyhow, the return on investment, there's a tech analyst for DA Davidson. His name is Gil Luria, and he's well known and well respected. And he's done a deep dive into CoreWeave, and I'm not trying to pick on that company, but he looked at everything, talked to the suppliers, all of that, looked at what they're spending and what they're getting, and he basically said that CoreWeave is in the business of selling $10 bills for $5, which is a pretty concerning statement coming from an analyst who is that high profile and respected, that he's just looking at the amount of spend versus the return and the ramping and everything, all of the metrics, all of the numbers. He said, yeah, CoreWeave's in the business of selling $10 bills for $5, which is kind of brutal. And then the second comment was an analysis came from someone I mentioned in the last video, Michael Burry, from The Big Short, which is quite an amazing story. Maybe someday we'll go back and just do stories throughout history about The Big Short and how it developed. And but Burry has been put out a few things on social media and has been excoriated, has been raked across the coals for his comments about the possibility of a bubble in AI. And yet, people like Sam Altman, who is the CEO of OpenAI, remember right at the middle, we've got OpenAI and NVIDIA. And side note, I'm not as worried about NVIDIA, quite honestly, because they're the ones that are doing the selling. You know, there are some concerns with circular financing, which I'll just briefly touch on in 2 seconds, but NVIDIA does make the best chip in the world, and we are talking about so many chips, but OpenAI is not a profitable company. Obviously, we don't know all of the numbers because it's not public, it's still private, but even based on a $15 billion revenue forecast, and if you go with Sam Altman and he says, oh, it's higher than that, so 20 billion or 25 billion, I'm sorry, the company is still currently valued at over $500 billion and rising. And they're saying there's no question this is going to get to $1 trillion. Well, that's price to sales ratio that is a little bit of an issue, not the point. But even Sam Altman said that, yes, AI is a bubble. He said, of course, everyone is overbuilding and it's going to be too much build at some point in time. It's only a question of what, when, and how much. And so anyhow, Michael Burry, Dr. Burry, called that into question. And to back up his statements, his posts, he pointed out that the largest companies, after doing the research, they are taking all of this equipment, semiconductors specifically, and they are depreciating them over a schedule of 6 years, when in fact, the useful life is 2 years for a chip, for a semiconductor. So they are overestimating the useful life and depreciation by a factor of 3, which by doing that on your expenses, you are artificially inflating your earnings, okay? And so he's saying that this is some financial, uh, I don't want to say untruth, but that needs to come back to what's realistic and literal of you're able to use these chips 2 years or maybe 3 before you need to replace them and upgrade, or they've expended their useful life. And so when that when those earnings get compressed back to reality, the amount of market reset in terms of those huge companies, remember, that are currently propping up so much of the market, when that compression happens, it's going to be significant. So the one other thing is that there is a larger and larger amount of private equity that is investing into these pre-public companies, okay? Private revenue. You invest in a company such as Blackstone, such as KKR or Ares, and you give them your money and they invest in companies that are not private yet, and you don't see what's going on. It's very opaque, the numbers. You have faith in Blackstone, let's say, but you don't know about the financing of everything I've just been talking about with OpenAI and other companies, other AI companies that are not yet public. So there is a concern because private equity has been pouring money into those pre-IPO artificial intelligence companies, which can just, put a little more fuel on the fire. I guess that's an old school way of showing lighter fluid. For those of you that are my age, you're going to remember the cans where you had to squeeze it and it was like tunk, 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 like the metal. Anyhow, sorry guys, I diverge. But the last part of it is and again, going to this kind of shift from real optimism to, I wouldn't say pessimism, but definitely questioning the AI play and the tech play right now. And one other piece of that is the circular financing that is occurring. Okay. The largest companies going from cash to debt. And then those companies within themselves, not they are using, there's circular financing going on. This company may invest in OpenAI, but AI is buying their data center capacity, their semiconductor equipment. In the meantime, OpenAI is renting cloud space from this company, and in exchange, they're buying some of it's all within that tight circle of artificial intelligence. So just the focus of money and just the money exchanging hands and then throwing the debt into that roundabout, like me giving you $5, you giving it to him, and then I get it back from your chatbot and their cloud computing and my semiconductors. Well, what's really happened? That $5 has made the rounds, but it's just back to me. But remember, you're also throwing debt into this and private equity and all of that. And I'm not this isn't about getting anyone scared. This is just about sharing with you a significant change in the feel of the market right now, that everything was really just so optimistic and anything was just being rewarded, and now there's much more questioning and selling going on, and these are a few of the things that go into it. And I told you about the higher speculative trades that have been unwinding a little bit. And so I'm going to leave with one other thing. That's kind of what's happening in technology and AI. But there has been a rotation in the market. The market hasn't been been hit really hard and going down because there is some money coming out of tech and the questions are being asked, but the money right now is going into a few other things in the last 2 months. One is energy, and energy is a little bit tricky because it's a commodity play. And we will talk about oil and natural gas and commodities in general, but the best sector with the best, nice, steady increase over the last 4 to 6 weeks has been healthcare. And I just want to point that out. And I'm not saying it's a great time to buy it or anything like that, but there is focused money going into that area and staying in that area too. Um, and remember, well, not remember, but within healthcare, there are a lot of different, parts to it. There are plan providers, healthcare plans like United Healthcare and, Cigna, and there's biotechnology, there's pharma, big pharma, um, and it's. But anyhow, healthcare as a sector is seeing inflows, and also when things do get concerning in the bigger sense of the market, there are places where in history the market will go for safety. Healthcare is one of them, and consumer staples are another. Consumer staples being things that we cannot do without. Okay, we don't have to buy a new car, but we do need to buy, you know, uh, food and toilet paper and toothpaste and by food I mean food at home because right now the restaurants are getting slammed. But that's a side note. Okay, I'm not going to make it too long, but that is I'm excited. That is the first vibe and pulse of the market right now. And I'll look forward to more of them with you. And again, it's not about action and do this, do that. It's just this is what's going on. This is what I see and feel. And so I hope that's been helpful. Look forward to more. That's it for today's show. Thanks for watching Wall Street Weatherman. I'll see you soon in a couple days or sooner.